Hello all, I'm honored to be up here. Thank you so much, Dan and BizTimes for having me up. It's a pleasure to share what we're up to at MLG Capital and what we're seeing in the market from a capital markets perspective. So I thought I'd start with a really brief intro on MLG Capital and our portfolio. One metric I want to cite on the slide here is across the country, we own roughly 29,000 apartment units. And I thought it'd make sense to bring that back to Wisconsin today. Roughly 15% or 4,400 units in Wisconsin are owned by MLG Capital. We own and manage those. We're a vertically integrated firm. In addition to owning and operating in Wisconsin here, we have a large presence in Dallas, Texas, also in Sarasota, Florida. We deploy our partner capital through two strategies. The first is a series of funds. We're on our sixth of our series of private funds. That fund, we've raised $350 million of capital to date, and we're seeking to raise the balance, the last $50 million, between now and year end. So would welcome subscriptions from anyone in this room. And in addition to that strategy, we accept contributions of real estate in exchange for units of our legacy fund. This is a tax-deferred offering. We launched this strategy in 2020. Our first contribution was in February of 2021. And to date, we've had roughly $1.5 billion of real estate contributed to this fund. And we're under LOI or contract on another $200 million worth of real estate. That fund in particular has pretty heavy concentration here in Wisconsin. And I'm excited to share a bit on the capital markets and both the operations, what we're seeing across our portfolio nationally and locally. So with that, let's jump into capital markets. I think this first slide is the most telling slide of what we're seeing from the capital markets today. It tracks over roughly the last 30 years how interest rates and cap rates have moved. And what you'll see in recent years, and I'm sure this is a surprise to no one in the room, interest rates have moved quite a bit and in the wrong direction in terms of getting deals done. In the last 2-3 years, they're up roughly 300 to 350 basis points, depending on the indice that you track, whether it's SOFR, the short-term rate, or the 5- and 10-year treasury. Cap rates in that same time period are only up roughly 150 basis points. So interest rates and cap rates, certainly a relationship, but they don't move one-to-one. And that recent heavy interest rate spike has resulted in some challenges as it relates to multifamily investments today. The challenges with higher interest costs, that means lower cash-on-cash returns to equity investors. And equity investors have plenty of alternatives in the marketplace, and we've seen some increased demand for products like high-yield savings accounts, private credit, and fixed income. And that's resulted in more challenges to get real estate deals done. I would say the opportunity is today, we're seeing less capital come into the space. And while, yes, you do have to accept the lower year one cash-on-cash return to come to the space, and I'll get a little technical on how we get there in the next slide, we expect investors will be rewarded for that in the long term. Generally, it's a buyer's market. There's more capital leaving the space than entering the space. And because of that, now is a great time to be deploying capital into private real estate. One metric that I think substantiates or affirms that point is if you look at the green line on the chart here, that's multifamily cap rates and how they've moved. You can see in roughly the last 15 years, we're at nearly a peak. That's a compelling point. Tells you now may be a good time to be a buyer. This is some good CBRE data. It also shows cap rates going down roughly 100 basis points in the next 5 years. Compelling data point for multifamily investors and developers alike. All right, there's a lot of data on this slide, but the punchline is it's harder to raise equity because real estate investments and developments require more equity today, and the equity returns are down again because of that increased cost in private real estate. So the first chart on the top left simply shows how much treasuries have moved, but the borrowing costs in private real estate aren't all about the underlying treasury. Lenders have to add their spread onto those indices, and that's what we show in the second chart there. A couple of years ago, we were borrowing typically in the 3% range. Fast forward to today, the cost of debt is nearly 2x what it was. Real estate is an incredibly capital intensive and debt dependent industry. That's had a real impact on pricing. So the bottom chart, what I'd like to focus on, the chart labeled 3, shows that a property, let's assume it's a 100-unit multifamily property, had $1 million in NOI back in 2021. An investor may pay a 4.25% cap rate for that. Now, this is some national data. I would say that low cap rate may be more consistent with some Sunbelt high growth markets than what we're typically seeing here in the Midwest and in Wisconsin in particular. But a 4.25% cap rate with 3% debt shows pretty clearly here that property would pretty easily size into 65% LTV, and the investor could get a 5.3% year one return. Fast forward to today, with the change, increased interest rates, that same project likely only sizes into 60% financing, and on top of that, the investor is only going to get a 3.8% year one return. Again, I'm just citing the year one return. I think that's real estate we know not only provides cash flow, but also provides appreciation potential. So I think it's somewhat short-sighted, but this next chart quantifies why so much capital has left the space, or why capital has been less eager to enter the space, I should say, and where it's going. So the Stanger Market Pulse, it's the source of this data. They track numerous private alternative investment, really across real estate, private credit, private equity, et cetera. And they provide some great data to show how equity inflows to private real estate have changed over the last 4 years. And what you'll see, 2021, a peak year in both, or in non-traded REITs, DSTs, and TICs and opportunity zones. So the latter of those two, tax-deferred strategies, the non-traded REITs, that's, for instance, Blackstone's B REIT product, Starwood's S REIT product. 3 and 4 years ago, some of the biggest buyers of real estate across the country. The data shows in 2024, they are on track to just accept 27% of the inflows they had 4 years ago. This shows you there's far less capital coming to the space than 3 and 4 years ago. And there was a lot of capital coming to the space in 2021. There was a point in 2021 where if we had the opportunity to review a multifamily or an industrial deal and we got wind that Blackstone was looking at it, there was a chance we were going pencils down because they were just going to beat us. But it's been a dramatic fall off. And right beneath that, it shows where capital is going. Private credit in that same time period has seen a 250% increase in capital inflows. So this capital is chasing yield. The bottom 2 bullet points I think are telling. In 2021, if you invested in the risk-free treasury, you could have expected a return of about 1%. And when you compare that with the real estate return we showed on the last slide of about 5.3%, capital was flooding into real estate compared to today. The risk-free rates are in the 4 to 5% range. Real estate, again, lower cash on cash yields. Again, this is multifamily specific, but we have conviction that the folks that deploy capital today will be rewarded in the long term. This data mirrors the data presented on the last slide, but it's actually related to public offerings and public issuances to raise capital to be invested in real estate. The institutional data is harder to track. I'm confident they would share that they're rebalancing their portfolio as interest rates went up, their fixed income portfolios, the values of those went down. Generally, they're net sellers of real estate, or they're allocating less to real estate to rebalance their portfolio. So with this common objection we hear, with cash flow down in private real estate, why allocate to private real estate? Why not go into some of the alternatives? So we thought it'd be fun to put together a schedule that shows, all right, if you invest in a treasury at 4.3% return, $1 million, and you maintain that position for 20 years, and compare that with a real estate investment that offers both cash flow and appreciation, what's that going to look like over the long term? And it's telling. With a real estate investment, you're going to have an extra $3.3 million in your pocket. So while you may not be excited to give up a little current return today, over the long term, I think there's a compelling case to be made. And I'm a CPA. I'd be remiss if I didn't share the tax benefits of investing in real estate as well. Some nice losses from the real estate investments from a tax perspective, very tax sheltered. So to summarize, it's a challenging environment out there to put deals together, to raise capital. There are some constraints on the debt side, but we're seeing more constraints as it relates to raising capital for deals, and deals generally require more capital because of the recent changes in interest rates and cap rates. Ultimately, we believe this is a good time to be acquiring for that reason. And our message is, let's beat the herd. Let's acquire property today at these high cap rates, and we'll stand to benefit when the institutions and the retail investors come back and drive those cap rates down in the future. Now, just a couple minutes of notes on the operations, what we're seeing across our portfolio, and I'll compare and contrast the Midwest and Wisconsin in particular to the rest of our portfolio. And I think it's also important to note the cost of capital isn't the only thing that matters to making these investment and allocation decisions. It's ultimately the underlying investment you're making, and there's a very positive story to be told as it relates to multifamily investing today. So I think this chart, this first chart, is the most telling. So we'll start with the dark blue line. The dark blue line is the rent growth, and this is multifamily again. The light blue line is vacancy. And what you can see over the last 24 years, rent growth hovering in that roughly 3% range, but certainly some ups and downs. I'd like to focus on the last 4 years in particular. Nice run up. It was a fun time to be a landlord because of COVID. Tenants had some COVID cash, were demanding more space, folks were spending more time at home, and new development was being slowed in many instances. Ultimately, that resulted in some outsized rent growth for that period of time. But what we saw was really across the country, more so than here locally, a large influx of supply. In 2024, there are going to be 600,000 new multifamily apartments delivered across this country. I would argue that our country only needs roughly 400,000 annually. That new supply has had a major impact on rent growth and vacancy. There are some operational headwinds in multifamily today because of that excess supply. We believe this is going to be a temporary condition. Developers and investors had the benefit of increasing rents, tight vacancy, really low interest rates and really low cap rates 2 and 3 years ago. That fueled the development that's being delivered today. We've got a chart that we'll show in a couple slides that shows how new development starts have really declined in the past couple of years. It's a challenging formula to develop, today, just based on the kind of tail end of this chart. So there's been some excess supply. That excess supply, I think, should be noted, is in large part concentrated in the Sun Belt. Even if you just look at our portfolio, our Wisconsin portfolio is roughly 95% occupied. Compare that to our Sun Belt portfolio, we're between 91 and 92% occupied. The high growth states, Texas, Florida, Tennessee, the Carolinas, have seen a disproportionate amount of the development flock to those markets. The Midwest in general has held up well. It has been more stable than the last slide, and it's held up well. But demand in general is a tailwind for multifamily developers. Our country, roughly 340 million people, growing 50 basis points a year. We are growing as a country roughly 1.7 million people. We have 131 million households, so roughly 2.5 or 2.6 people per household. If that household formation continues at a clip of about 1% per year, we're going to need roughly another 400,000 units per year. That's going to be a tall task for developers to keep up with in the current environment with higher interest rates, higher cap rates. So just a last thought on new supply, because I see my shot clock's about to expire here. I think this chart is really telling in terms of the new supply trends and the recent downtick in new supply. There is a 9-quarter period, if you look at that top right portion, in the middle of 2021 through really the middle to late of 2023, where starts exceeded 120,000 per quarter. The last 2 quarters, multifamily starts fell down to 80,000 and then 60,000, and they're trending even lower. It's a tough environment to develop. Our country, our city needs a lot of housing, and the math is challenged right now. We believe as investors that will result in the supply-demand imbalance today will rebalance in the future, and there's great opportunity to acquire high-quality real estate at a good price. One last note, just related on the affordability, multifamily is going to be a key piece to providing affordable housing in this country. Single-family homes are so unaffordable. The data on this chart is telling 130% increase, 132% increase in home values. That doesn't include the financing costs compared to rents up 71% in that time period. So I'll just finish with one quick conclusion page. Capital markets perspective, there's not as much capital coming to the space. From an operations perspective, we're seeing some challenges with excess supply today. We think that's going to be a short-term condition because of how challenged new developments are today. And ultimately, in the long term, deploying your capital into real estate acquisitions today, you could stand to benefit from both capital coming back, cap rates going down, and the challenged new supply may lead to outsized rent growth in the future. So that's what we have. Thank you so much for the time today. Really appreciate it.